But wait, there's a crucial anomaly right there in the small cap space. The Russell 2000 proxy, IWM, is actually up 0.70% to $263.19. What does this divergence tell us? It screams rotation. Money isn't fleeing the entire stock market. It's moving away from the perceived giants and into the smaller, perhaps more domestically focused, names that might benefit from a shift in the economic narrative. When the biggest stocks dip while the smallest ones rally, the market is signaling uncertainty about the reliability of the established growth story. The fear gauge, the VIX, is ticking up almost 5% to 16.75. That's not panic, but it is a distinct uptick in implied volatility, a sign that the market expects more fireworks, more surprises, in the immediate future. This feeling of unease is palpable when we look at the damage done to our technology darlings. Microsoft, MSFT, is down 2.40%. Amazon, AMZN, is suffering a 2.45% loss. Nvidia, NVDA, the AI kingpin, is retreating 1.44%. These aren't minor jitters. These are significant moves indicating a potential cooling in the growth enthusiasm that has powered markets for so long. This movement isn't happening in a vacuum. It's a direct reaction to the competing narratives being spun by our economic architects and business titans. We have fresh inflation data landing with a thud. US inflation is reported as stronger than it looks. That's a direct counterpoint to the recent encouraging employment data, a truly bizarre juxtaposition where the economy added a disappointingly low 22,000 jobs, pushing unemployment higher, yet prices are sticking around. This creates a classic stagflationary dilemma, and the markets are trying to price in what the Federal Reserve will do next. When inflation is sticky but job creation is weak, the Fed's path becomes an impossible tightrope walk. And speaking of the Fed, we hear from Chairman Jerome Powell, who, according to reporting, isn't backing down from his tough stance. Globally, the pressure is mounting. The ECB's Kazakh notes that the European banks are feeling the heat as the Fed's actions raise risks abroad. Meanwhile, the UK is hearing whispers that inflation might fall fast. Imagine the confusion: US prices stubborn, European banks nervous, and UK inflation expected to retreat. It's a fragmented global playbook. Then we turn to the corporate titans, and the mood is far from celebratory. Nvidia's CEO, Jensen Huang, reveals he works 7 days a week in a constant state of anxiety fearing bankruptcy. That vulnerability from the leader of the most critical sector, AI, sends a chill down the spine of the market. Warren Buffett draws the starkest comparison, equating the risks of AI to those posed by nuclear weapons. The genie is out of the bottle, and nobody knows the safety protocols. Even as some focus on the risks, others, like Michael Burry, stick to the value investor mantra, looking for the currently unpopular but solid companies. On the policy front, we see the fallout of political maneuvering affecting business sentiment, with stories involving Jamie Dimon, Donald Trump, and George Soros highlighting the intricate dance between governance, regulation, and capital. The very fabric of innovation is being scrutinized, as evidenced by the California investigation into Elon Musk's AI company, juxtaposed with Sam Altman suggesting ChatGPT will become more friendly again. It's a world where the builders are worried about collapse, and the regulators are circling the innovators. Let's pivot to the foundation of finance, the bond market. The 10-year Treasury yield, denoted by the caret TNX, has nudged down by 0.74%, resting at 4.14%. This decline in yield, despite the narrative of sticky US inflation, is telling. Why would yields fall when inflation data is hot? Two primary reasons connect the dots here. First, the pathetic jobs report, only 22,000 jobs added. That weak labor print screams economic slowdown, which is naturally deflationary and drives bond prices up, yields down. Investors are prioritizing the risk of recession over the current pain of inflation. They are seeking safety in government debt, betting that the Fed will eventually have to pivot or that the current economic momentum is fragile. Second, the flight to quality. When growth stocks like MSFT and AMZN are dumped heavily, where does that capital flow? A portion of it lands squarely in treasuries, pushing yields lower. So, the bond market is essentially voting against the resilience of the broader economic recovery narrative being fueled by inflation data. The bond market is whispering, slow down ahead. The confluence of macro data forces us to focus laser-like on the upcoming Federal Reserve meeting. The market is poised, waiting for a decision on interest rates against a backdrop where inflation remains stubborn, but employment is clearly faltering. If the Fed holds firm on high rates to fight the stronger than it looks inflation, they risk accelerating the economic slowdown hinted at by the jobs report and the weak performance of growth stocks. If they ease too early, the inflation fight is lost, potentially leading to the kind of sustained price pressure Warren Buffett fears. Globally, the ECB is worried about external pressures, primarily from the strong dollar environment likely caused by Fed policy differentials. The message from the central banks is one of high tension. They are caught between the mandates of price stability and full employment, and right now, the data suggests they cannot satisfy both. The market's VIX UPTICK reflects this policy uncertainty perfectly. The commodity complex offers another slice of the mixed economic pie. Crude oil, CL=F, is taking a significant beating, dropping 3.39% to $59.92. This is a classic indicator of anticipated global economic weakness. When traders expect lower growth, they expect lower energy demand. This sharp drop in oil prices provides a potential deflationary counterweight to the sticky CPI data we heard about. Contrast that with gold, GC=F, which is only down 0.26% to $4,614.40. Gold, the traditional safe haven, is holding its ground remarkably well, especially considering the decline in yields we just discussed. This stability confirms the high underlying uncertainty. People are willing to pay for insurance, gold, even as fears about economic growth, oil, cause major price erosion. The dollar index, DX, is slightly up, showing marginal strength, which often correlates with global risk-off sentiment, despite the internal yield pressures we saw in the TNX. The EUR/USD is nearly flat at 1.16, indicating that while the US economy is showing internal contradictions, it remains the focus of global capital flows. The performance gap across sectors is the clearest signal today. The high beta, long-duration technology names, Microsoft, Amazon, Nvidia, are leading the charge lower. Their valuations are built on projected future earnings, and when uncertainty rises, those distant earnings get discounted more heavily. Furthermore, the fact that NVDA, the bellwether of the AI revolution, is falling, suggests that even the most compelling growth narrative is vulnerable to a broader macro risk-off move. The technology downturn is being partially offset by the small cap rally in the IWM. This suggests that money is flowing into value, industrials, and domestic players who might be less sensitive to global tech supply chains or future discount rates. Even construction stocks, represented by construction partners, are reportedly hitting record highs, perhaps riding on localized infrastructure spending or the perceived stability of tangible, non-tech assets. This confirms the rotation narrative, safety and value over speculative, future-heavy growth. The digital assets reflect the risk-off sentiment gripping traditional equities, but with an interesting underlying strength. Bitcoin, BTC/USD, is down 0.5%, and Ethereum, ETH/USD, is down nearly 1%. They are tracking the risk assets, not the safe havens. However, we also see reports supporting the long-term thesis for both digital gold and digital value. Ray Dalio's firm's findings suggest that a Bitcoin and gold allocation outperforms traditional portfolios, reinforcing the hedge thesis. And Michael Saylor is back, arguing that the 4-year cycle might be dead, implying market dynamics are fundamentally changing away from simple historical analogies. What's key here is that while crypto is acting like a risk asset today, getting dragged down with QQQ, the intellectual debate around its necessity as a portfolio stabilizer, highlighted by Dalio's backing, remains very much alive. It's a market that hasn't fully decided if Bitcoin is a high beta tech play or Warren Buffett's AI risk antidote. The confluence of weak employment and sticky inflation means volatility is baked in. We are waiting for the Federal Reserve's tone next week, but the market is preemptively positioning itself for a downturn. The heavy selling in MSFT and AMZN suggests analysts are already pricing in a potentially weaker consumer environment in the near term, despite the inflation reports. Keep a very close eye on that IWM strength. If the small caps continue to outperform the large caps tomorrow, the rotation narrative is confirmed, signaling a shift away from a narrow market leadership toward broader economic participation, or perhaps just a defensive scramble. Today's data points to economic contradiction: weak jobs, hot prices. The market hates contradiction. What we are witnessing is the market grappling with complexity. It's not one story, it's several warring narratives colliding. We have the inflation narrative fighting the recession narrative. We have the unstoppable growth of AI being tempered by the anxiety of its own leaders. We have bonds signaling a slowdown while CPI screams hot. The connecting thread is uncertainty. The VIX is rising because Powell's next move is opaque, and the economic inputs are contradictory. Money is shifting from the high-flying stars, QQQ, NVDA, into perceived value or domestic stability, IWM. My final takeaway is this: the market is pricing in a soft landing that may be wobbling. When the giants stumble but the small businesses hold steady, it means the foundation is cracking, but the local economy is still putting one foot in front of the other. Stay agile, watch the yield curve, and understand that in a contradictory market, cash flow today is king, and tomorrow's promises are viewed with extreme skepticism. That's the story of today's price action.